With over 1,70,000 crores of assets under management, the Flexicap category is the second largest amongst equity mutual funds. Now, what makes Flexicap funds so attractive to investors is the fact that fund managers can invest money across different companies and in different sectors without any restriction. This freedom and flexibility means investors might and probably will demand a lot more from the fund managers when compared to other fund categories. But the first step for any fund manager is to beat the benchmark, and in the case of Flexicap funds, that benchmark is the Nifty 500 Total Return Index. In this video, we shall take a closer look at the Flexicap category, and we continue to draw comparisons with the Nifty 500 on many parameters like the capitalization structure, investment style, sector preferences, and of course the performance metrics. Let's begin. The mutual fund universe, the large caps, mid caps, multi caps are all defined by the size or capitalization of the holdings within a scheme. In that regards, Flexicap, although it does have the word cap in it, is not defined rigidly, but it is actually characterized by the luxury of being able to bob and weave across different market capitalizations. This flexibility ideally allows them to adapt faster to changing business cycles, taking advantage of sector rotations, manage market volatility, and minimize the downside risks. In other words, the investor is counting on the fund manager not simply following the Nifty 500, but actually using his or her flexibility to its maximum and charting its own path. And there are many ways of verifying this. The first way is to examine the number of holdings, that is, the number of companies that the fund has. Now, the Nifty 500 has 500 companies in it, and we shouldn't expect any Flexicap fund to match that. But what is an ideal number? Because if this number is high, say 50 companies or even more, then it shows a low level of conviction and a tendency to play it safe around the Nifty 500 benchmark returns. But if the number is too low, then there might be a tad more risk in that particular fund, as some bets may or may not work as expected. We did a quick check of the more popular schemes within the category, and the Parag Parikh Flexicap fund came out as the odd man with just 26 companies in its portfolio, which is surely some good conviction shown by the fund team. In our opinion, the schemes which have over 50 holdings need to be understood a little more. And that's where a second indicator comes in, which is the predominant market capitalization of a fund's holdings. Now, do recall we said that Flexicaps can play across the universe of 500 companies and are expected to be exploiting the more visible opportunities, whether they are in large caps, mid caps, or small caps. However, when we look at the data, one can't fail to observe the heavy skewness that's there towards large cap companies. In fact, every scheme other than the PGIM India Flexicap fund has at least 65% of their holdings in larger companies, and it comes as no surprise that the PGIM fund, which is a mid and small cap heavy fund, is currently ranked number 1 in the Flexicap returns chart. But having said this pattern of large cap bias should not be construed as a lost opportunity, because while capitalization is a broader element, picking individual stocks within the available universe of 500 companies is what we are all banking on from the fund manager to do. So if the fund manager can find diamonds in the large cap bucket, then so be it. A third indicator that one might want to look at when it comes to Flexicaps is the sector representation in these schemes. Now, the Nifty 500 represents almost every business sector, and this should not come as a surprise. After all, there are 500 companies in that index. But the more prominent ones are the ones we all expect. Financial companies, which carry over 30% of the capitalization, which is then followed by almost similar proportions of technology, energy, and consumer good companies. Flexicap funds too aim to achieve adequate diversity across sectors together with a neat blend of stock picking. And this often speaks volumes of the investing style of the fund management team. For instance, we see a high proportion of energy stocks with HDFC's Flexicap fund, while the UTI fund management team has stayed away from it. Likewise, PGIM is thick into construction stocks like Larsen & Toubro, Oberoi Realty, and quite a few cement companies, while the Parag Parikh fund management team has no representation in that sector for now. In fact, as investors, the more we start looking at specific holdings, a lot more of the fund's investing style gets revealed. Net, comparing multiple flexicaps amongst themselves or even with a single benchmark like the Nifty 500 might be a lot difficult than previously imagined, but what would help is a better understanding of these second level variables, which will certainly improve your investing decisions. For many years, a question on a domestic fund with exposure in international stocks had a default answer, which was the Parag Parikh Flexicap Fund. The single fund has maintained an allocation of around 30% of its corpus on select foreign stocks for quite some time now and includes a handful of notable names like Alphabet, Facebook, Microsoft, and Amazon. These international stocks have been hugely rewarding for the Parag Parikh Flexicap Fund, with each of these 4 stocks delivering annualized returns of 20% to 38% over these last 5 years. But now things have changed. Today, we see many domestic funds offering or making a provision in their scheme document allowing for allocation of assets towards foreign stocks. So why do that? We think there are 2 reasons for this, and diversification is not one of them. The first reason that's prompting fund houses to look beyond the borders is to expand the set of quality companies. You see, while we say India has 5,000 plus listed companies, in our assessment, only about 300 of these companies are actually investable. So effectively, the 10 lakh crores of mutual fund money that is there in equities is all going to these 300 investable Indian companies, which as a consequence is leading to an undeserved price appreciation in these stocks. Which means by accessing thousands of foreign companies, fund houses can expand their selection bucket and deliver better risk-adjusted returns to their investors. The second reason that's prompting a lean towards international stocks is on account of returns. Now, a comparison of returns over the past 10 years, that is the period from 2011 to 2020, shows that international equities have outperformed the Indian equities. Case in point is the MSCI All Country World Index, which delivered an annual return of 14.5% over the last decade, which is a lot higher than the 10.1% return that the Nifty 500 TRI delivered during the same period. Now, from our perspective, that is when comparing a Flexicap fund's performance with the Nifty 500, there is a strong case for us using the wrong benchmark. For instance, the Parag Parikh Flexicap Fund has the Nifty 500 as its benchmark. However, this fund has been allocating 30% of its assets to companies that are listed on the Nasdaq 100. So what might seem a credible thing to do is to use a combination, say 70% of Nifty 500 and 30% of the Nasdaq 100 index as the right benchmark for that fund. Nevertheless, as more schemes start adopting international stocks within the Flexicap space, the need for improved benchmarks is likely to come up when doing these comparisons. Since most of today's Flexicaps were yesterday's multi-caps, the true comparison of Flexicap funds is often done with the large cap funds and funds in the large and mid cap category. From a performance perspective, there is not too much to choose from between these categories, but if you really want to be precise, then it's the large and mid cap category that seems to have delivered slightly higher returns than the others over these last 5 to 5.5 years. In our opinion, this somewhere seems to connect with our earlier observation that Flexicap funds are generally skewed in favor of large caps, while funds in the large and mid cap category have to compulsorily have at least 35% of its assets in mid caps at all times. Having said this, we won't focus too much into this, as this large and mid cap category is quite a recent development and there are not too many years of data available here. Instead, let's now pan our attention to the performance of the many schemes that are available under the Flexicap category. Here again, we focus on the last few years and map out the best returns, the worst returns, and the median returns for every year. For instance, for the year 2021, and at the time of recording this video, the top performing Flexicap of the year had delivered a 46% return, The worst was at 21% and the median return was at 34%. Now, when we do the same exercise for all the other years, we start getting a decent idea of how Flexicap funds have performed in positive and negative cycles through the last few years. Another reason for this mapping is really to see where the Nifty 500 TRI is positioned in the returns chart. After all, the Nifty 500 is the benchmark and it's the number that all Flexicap managers are aiming to beat. The data here shows that the Nifty 500 TRI performance is very close to the median performance of the Flexicap funds. This effectively means that there is a 1:1 selection risk, which is another way of saying that if you choose and invest in two Flexicap funds, it is very likely that one of the funds might underperform the benchmark. In fact, to this point, we went ahead and even mapped the performance of 20 Flexicap funds across multiple years to see if there is some consistency or pattern that's worth studying. While none of the schemes had beaten the benchmark in all 6 years, there were some schemes which had given an alpha over the Nifty 500 in 4 or even 5 years, which I thought was pretty remarkable. In fact, what was more remarkable, and I might be gloating a bit, is that all these funds which had outperformed the Nifty 500 were also the top rankers per our in-house algorithm that puts together the ETMONEY category ranking. So if you're unsure of which Flexicap fund, or for that matter, which scheme you want to invest in, or if you need a second opinion, then do access our fund report card on the ETMONEY app and website. This report card will give you a scheme's ranking, performance potential, and downside risk, which you can then use to invest or review your mutual fund portfolio. Before we researched for this video, our team here at ETMONEY was a divided lot. Some felt that Flexicap funds are better, while others were convinced that investing in a Nifty 500 index would yield better results. The good thing is that this study we just presented did help clarify some of their contentions, and for now the warring factions are at peace. So what did we understand here? For one, we know that all Flexicap funds are not similar by a fair magnitude, and we saw that in terms of the number of stocks they hold, their capitalization type, and the sectoral distribution. We also drew a comparison on the inclusion of foreign stocks, which is likely to move from being a trend to being a norm in the Flexicap funds within a year or two. Of course, the Nifty 500 would not be holding any foreign stocks. And finally, we learned from a returns perspective that half of the Flexicap funds were outperforming the Nifty 500 index, while half of the funds were underperforming it, giving investors that tingly 50-50 sensation. But what's interesting, and I think we haven't mentioned this earlier in the video, is that the top quartile of Flexicap funds, that's the top 25% of the funds by returns, have almost always ended up delivering an alpha of 5 to 8% over the Nifty 500. A 5 to 8% overperformance is quite a lot, and it shows the importance of fund selection, the good side of getting it right and the bad side of getting it wrong. Now, I make this point to open up this idea of building a 50-50 active-passive portfolio for oneself. What I mean is, most investors will look to invest in or will be primarily invested in actively managed funds. Now, we have seen this in other videos and also in this video that there is a 1:1 selection risk, which means you are as likely to be wrong about a fund as you are likely to be right. So in order to reduce the risk of acute underperformance, an investor can consider moving some part of their portfolio, that is, in actively managed funds, towards a passively managed index fund. By doing this and keeping some part of your portfolio exactly aligned with the market performance, you will be lowering some of the potential overperformance, but also importantly, you'll be protecting it from acute underperformance. This transition need not be a big 50%, but maybe one can look at a 10%, 15% to start out with. And once you get more comfortable with it, you can start moving a little further. So that's some food for thought, and we would encourage everyone to definitely think through it and even debate it with your friends or with us in the comment section below. But yes, if you are comfortable with actively managed Flexicaps, but need some help with deciding on the ideal funds, then do check out the ETMONEY Fund Report Card for some useful insights. And with this, we come to the end of this video. I sincerely hope you found this video useful and will use it to improve your own investing strategies. Once again, thank you for your time. Please do subscribe to our channel, do tap on that like button, and I look forward to catching up with you very soon with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.